You just closed 3 winning trades in a row. Your account is up 12% this week. You're seeing the market with perfect clarity. Every setup you identify works. Every entry is timed beautifully. You feel invincible. Then, you see the next setup. It's not quite perfect. Your trading rules say it's borderline, but you know this will work. You can feel it. You've been right all week. Why would this trade be different? You take it with double your normal position size because you're so confident. You tell yourself you're not being reckless, you're capitalizing on your hot streak, you're trading with conviction. The trade fails immediately, violently. In 23 minutes, you've given back 8% of your account. Most of your weekly gains are gone. You sit there stunned, trying to understand what just happened. What happened is that overconfidence destroyed your trading discipline. And it's not the first time. It's a pattern that repeats every time you have success. Win a few trades, confidence becomes overconfidence. Overconfidence leads to rule violations. Rule violations lead to devastating losses that wipe out your progress. This cycle keeps you trapped. You're good enough to build your account up, but overconfidence always tears it back down. And until you understand the psychological mechanism behind overconfidence in trading, you'll keep repeating this pattern forever.
The hidden danger of overconfidence in trading psychology. Here's what most traders don't understand about overconfidence. It's not the same as confidence. Confidence in trading is believing you can execute your strategy consistently over time. Overconfidence is believing you know what the market will do next. Confidence says, I have a trading edge that works probabilistically over many trades. Overconfidence says, I know this specific trade will work because I can read the market. That distinction is everything. Confidence keeps you in your process. Overconfidence takes you out of your process. And your process is the only thing that actually works in trading. Overconfidence in trading psychology emerges from a cognitive bias called the illusion of control. After a series of winning trades, your brain creates a false narrative that you controlled those outcomes. You didn't just execute good setups that happened to work, you made them work through your skill, your analysis, your superior market reading ability. This illusion is powerfully seductive because it feels amazing. You feel competent, skilled, almost clairvoyant about market movements. Your emotional brain releases dopamine, the same neurochemical associated with reward and pleasure. You're experiencing a psychological high from your recent success. But here's the brutal truth about markets. You never control outcomes. Ever. You only control your decision-making process. Even your best setups, analyzed perfectly and executed flawlessly, will fail 30, 40, sometimes 50% of the time. That's the probabilistic nature of trading. When you're overconfident, you forget this fundamental reality. You start believing your recent success means you've figured something out, that you're operating at a higher level, that the rules that apply to other traders don't apply to you right now because you're in a flow state or on a hot streak.
The 3 faces of overconfidence. Overconfidence doesn't appear the same way every time. It has 3 distinct manifestations in trading psychology, each with its own destructive pattern. Phase 1. Post-success overconfidence. This is the most common form. After a series of winning trades, especially if they're larger wins or if they came from particularly good analysis, your confidence inflates beyond appropriate levels. The internal dialogue of post-success overconfidence sounds like this. I've nailed the last 5 trades. I'm clearly reading this market correctly. I'm in sync with price action. This is when I should be most aggressive. Strike while the iron is hot. Increase size. Take more trades. Capitalize on this momentum. This feels logical. It feels like you're being strategic, maximizing your edge when it's working. But you're actually abandoning your process precisely when you should be most committed to it. Your edge isn't working better this week. Your edge is probabilistic and works the same way whether you win or lose short-term clusters of trades. Phase 2. Analysis overconfidence. This form emerges when you've done extensive analysis on a setup. You've looked at multiple time frames, you've checked all your indicators, everything aligns perfectly. The setup is textbook. The internal dialogue sounds like this. This is the most obvious setup I've seen all month. This cannot fail. The confluence is perfect. I've checked everything. This is basically free money. I should risk more than usual because this is as close to certain as trading gets. The problem is that even perfect setups fail regularly. The market doesn't care about your analysis. Unexpected news breaks. Large institutions execute orders that overwhelm your technical patterns. Random volatility spikes occur. Your perfect analysis gives you an edge, but it never gives you certainty. Phase 3. Experience overconfidence. This is the most subtle and dangerous form. After years of trading, after developing genuine skill, you start believing your experience makes you immune to certain mistakes. The internal dialogue sounds like this. I've been trading for 5 years. I've seen this pattern 1,000 times. I don't need to check my rules. I don't need to calculate position size carefully. I know what I'm doing. I can trade more intuitively now. Following rigid rules is for beginners. This is expertise being corrupted into overconfidence. Yes, you have experience. Yes, you have developed pattern recognition. But the moment you believe you're above your process, you're setting up for catastrophic failure. The market doesn't care about your experience. It will humble you as quickly as it humbles beginners.
Meet Yale, the trader who couldn't sustain success. Yale had been trading for 4 years when he finally recognized his overconfidence pattern. He was skilled. He had developed a solid trading strategy with proven edge. His backtests showed consistent profitability. His understanding of market structure was sophisticated. But Yale's equity curve told a strange story. It didn't go steadily up or steadily down. It went up in consistent chunks, then gave back large portions of those gains in sudden, sharp drawdowns. Up 15% over 3 weeks, down 11% in 2 days. Up 20% over a month, down 14% in 3 trading sessions. When Yale analyzed these drawdowns, he discovered something disturbing. They almost always occurred after periods of strong success. His biggest losses didn't come when he was struggling and trying to figure things out. They came right after his best trading, when he was most confident. Yale pulled up his trading journal and studied 6 months of trades in detail. The pattern was undeniable. After 3 consecutive winning trades, Yale's average position size increased by 38%. After 5 consecutive winning trades, he took 47% more trades than his strategy called for. After a week where he was up more than 10%, his rule violations increased by 63%. Success was making Yale dangerous, not to other traders, to himself. His trading psychology couldn't handle winning without morphing into overconfidence, and overconfidence always led to the same destructive behaviors: oversizing positions, overtrading, taking marginal setups, and abandoning his risk management rules. Inside Yale's mind, the overconfidence spiral. Yale decided to document his internal dialogue during a period of strong success to understand exactly how overconfidence took over his trading psychology. Monday through Wednesday, 3 consecutive winners. Yale executed 3 excellent trades. All met his criteria perfectly. All managed according to his rules. All hit their targets. He made 7% on his account in 3 days. Yale's internal dialogue Monday night. Great trading today. Stuck to the plan.
This is what consistency looks like. Keep doing exactly this. Yale's internal dialogue Wednesday night. 3 in a row. I'm really reading this market well. My analysis has been spot on. I feel like I'm in a zone. Notice the subtle shift. Monday was about process. Wednesday was about his ability. The focus was moving from execution to identity. Thursday morning, the 4th trade. Yale identified a setup Thursday morning. It met most of his criteria, but not all. The volume was slightly light. The risk-reward was 2-to-1 instead of his preferred 3-to-1. His rules said this was a pass. But Yale's internal dialogue went differently. Normally, I'd skip this because the volume isn't perfect. But I've been reading this market so well this week. I can see what others can't see right now. This is going to work. I'm not going to let perfectionism make me miss this opportunity. Sometimes you have to trust your instincts when you're trading well. Yale took the trade. This was his first rule violation, driven entirely by overconfidence. His recent success had convinced him that his instincts were more reliable than his tested strategy. Thursday afternoon, position size inflation. The Thursday afternoon trade stopped out overnight due to a gap down. He lost 4%. His week's gains were now 6% instead of 10%. Friday morning, Yale's emotional state had shifted dramatically. He was frustrated. That loss felt wrong, unfair. He had been trading so well. He didn't deserve that loss. A marginal setup appeared. It barely met any of his criteria. Normally, this would be an obvious pass. But Yale's internal dialogue was dominated by a specific flavor of overconfidence. The need to prove he was still right, still in the zone, still operating at a high level. That loss was just bad luck. A gap down, completely random. It doesn't reflect on my trading ability. I'm still reading this market correctly. I can make that 4% back easily. This next trade will prove I'm still in control here. Take it with big size. Show the market who's in charge here. Yale took the trade with 5% risk, 2.5 times his maximum allowed size. The setup failed within 30 minutes. Yale lost another 5%. In less than 24 hours, Yale had gone from being up 10% for the week to being down 3%. A 13% swing entirely due to overconfidence-driven rule violations that happened after he was trading at his best.
The anatomy of overconfidence destruction. Yale analyzed his pattern obsessively and identified exactly how overconfidence destroyed his trading performance. Destruction pattern 1. Risk management abandonment. Overconfidence caused Yale to systematically violate his position sizing rules. His risk per trade was supposed to be 1.5 to 2% maximum, but after winning streaks, his risk would inflate to 3, 4, sometimes 5% because he felt certain about the trades. This destroyed his risk management completely. A strategy designed to survive multiple consecutive losses couldn't survive when individual losses were 2.5 times the planned size. One bad trade could wipe out weeks of careful gains. Destruction pattern 2. Setup quality deterioration. When Yale was trading with appropriate confidence, he was selective. He took only setups that met all his criteria. His win rate during these periods was 64%. When overconfidence took over, Yale's selectivity disappeared. He took marginal setups because he believed his superior market reading could make even mediocre setups work. His win rate during overconfident periods dropped to 39%. He wasn't trading worse setups because he lost his analytical ability. He was trading worse setups because overconfidence made him believe setup quality didn't matter when he was in the zone. Destruction pattern 3. Overtrading frequency. Yale's strategy called for 3 to 5 trades per week based on his setup criteria appearing that frequently in his time frame and instruments. During periods of appropriate confidence, Yale averaged 4.2 trades per week. During overconfident periods, that number jumped to 11.7 trades per week. He wasn't finding more valid setups. He was lowering his standards and forcing trades because he felt he should be capitalizing on his hot streak. This overtrading increased his transaction costs, exposed him to more risk, and diluted his edge by including lower probability trades in his mix. Destruction Pattern 4. Recovery Desperation. The cruelest aspect of overconfidence was what happened after it led to losses. Yale would experience a psychological whiplash. His inflated sense of ability would shatter, but instead of returning to his process, he would become desperate to prove he was still capable. This desperation was just another form of overconfidence, the belief that he could force the market to validate his ability. He would take increasingly aggressive trades trying to recover losses quickly, compounding his mistakes. Yale's internal dialogue during these periods? I just need one good trade to get back to even. I know I can read this market. I just had bad luck. One more trade will prove that. Take it with big size, get back to even, and then I'll return to normal trading. This recovery desperation pattern turned manageable losses into catastrophic ones.
Yale's awakening, seeing the pattern clearly. The breakthrough for Yale came when he graphed his confidence levels against his trading performance over 6 months. He created a simple daily rating system. How confident did he feel about his trading ability each day, rated from 1 to 10? The results were shocking. His most profitable trading days happened when his confidence rating was between 4 and 7. His worst trading days, the ones with the biggest losses, happened when his confidence rating was 9 or 10. Low confidence, 1 to 3, also produced poor results because he was hesitant and couldn't execute his strategy properly. But the relationship between high confidence and poor results was more pronounced. Extreme confidence was more dangerous than low confidence in his trading psychology. Yale realized something profound. His optimal trading state wasn't confidence or overconfidence. It was humble execution. It was believing in his process while remaining uncertain about individual outcomes. It was confidence in his edge over time, combined with humility about his inability to control any single trade.
Yale's transformation, building calibrated confidence. Yale implemented 5 specific systems to maintain appropriate confidence levels and prevent overconfidence from sabotaging his trading. System 1. Success Awareness Protocols. Yale created a rule. After any 3 consecutive winning trades, he was required to complete a Success Awareness Protocol before taking another trade. This protocol included writing answers to these questions. Am I feeling overconfident right now? Am I thinking about increasing my position size beyond my rules? Am I considering taking trades that don't fully meet my criteria? Am I starting to believe I can predict what the market will do rather than just executing high-probability setups? If he answered yes to any question, he had to take a mandatory 24-hour break from trading. This cooling-off period allowed his inflated confidence to normalize before he made decisions. System 2. Position Size Lock. Yale programmed his trading platform with hard position size limits. Regardless of how confident he felt, he physically could not risk more than 2% per trade. The software would reject any order that exceeded this limit. This removed the possibility of overconfidence-driven position size inflation. He couldn't press his advantage even if his emotional brain was screaming at him to do so. The system protected him from himself. System 3. Pre-trade uncertainty statement. Before entering any trade, Yale implemented a mandatory statement he had to say out loud. I do not know if this trade will work.
Even with perfect analysis, this trade has a significant probability of failure. I am taking this trade because it meets my criteria, not because I know what will happen. This verbal reminder interrupted his overconfidence narrative. It forced him to acknowledge uncertainty explicitly, making it harder for his brain to slip into the illusion of control. System 4. Winning Streak Management. Yale created a counterintuitive rule. After 4 consecutive winning trades, his position size automatically decreased by 25% for the next 3 trades, regardless of setup quality. This felt backwards. Conventional wisdom says increase size when winning, but Yale's data showed that increasing size when winning led to disaster in his trading psychology. His new rule forced smaller size exactly when overconfidence was most likely to be taking over. After the 3 trades with reduced size, if he maintained discipline and didn't violate rules, he could return to normal sizing. This created a buffer period where overconfidence couldn't cause catastrophic damage. System 5. Process Focus Journaling. Yale stopped tracking his profit and loss prominently. He removed the P&L display from his trading platform during active trading hours. Instead, he focused entirely on process metrics. Did I follow my entry criteria? Did I honor my position sizing rules? Did I execute according to my trade management plan? Did I maintain emotional equilibrium? He scored himself daily on these process metrics, not on dollars made or lost. This kept his focus on what he controlled, process, rather than what he didn't control, outcomes, making overconfidence less likely to develop.
The deeper insight, redefining trading success. 6 months into his transformation, Yale had a profound realization while reviewing a particularly frustrating week where he followed his process perfectly but lost money on 4 out of 5 trades. Old Yale would have experienced this week as failure. His overconfidence would have been shattered. He would have questioned his strategy, his analysis, his ability. He might have changed his approach or taken aggressive trades to recover. New Yale experienced this week completely differently. His internal dialogue, I executed my strategy with discipline. I didn't violate rules. I managed risk properly. I can't control that these specific trades didn't work. I controlled my behavior, and my behavior was excellent. This is success, even though I lost money. This reframing was transformative in Yale's trading psychology. Success wasn't about being right. Success was about executing his process consistently. Some weeks that process would produce profits, some weeks it wouldn't. But as long as he executed with discipline, he was successful regardless of short-term outcomes. This perspective made overconfidence impossible. You can't become overconfident about your ability to control outcomes when you don't believe you control outcomes. You can only maintain appropriate confidence in your ability to execute your process. And that type of confidence doesn't corrupt into overconfidence because it's grounded in reality rather than illusion.
Yale's results, the equity curve transformation. The changes in Yale's trading results after implementing his overconfidence management systems were dramatic. Before systems, Yale's equity curve was volatile. Big gains followed by big losses. Monthly returns ranged from plus 18% to minus 13%. Annual return over 2 years, 7% with massive drawdowns. After systems, Yale's equity curve smoothed dramatically. Smaller gains, but consistent. Almost no catastrophic losing periods. Monthly returns ranged from plus 4% to minus 2%. Annual return over the next 18 months, 29%, with much smaller drawdowns. Same strategy, same market conditions, same analytical ability.
The only difference was that Yale had learned to recognize and control overconfidence before it destroyed his trading discipline. More importantly, Yale's psychological experience transformed. Trading stopped feeling like an emotional roller coaster. The highs weren't as high, but the lows weren't as devastating. He had found sustainable equilibrium in his trading psychology.
How to fix your overconfidence problem. Your action plan. If you recognize the overconfidence pattern in your own trading, here's your systematic approach to fixing it. Step 1. Identify your overconfidence triggers. Review your last 6 months of trading. Identify when your biggest losses occurred. Look at what happened in the days or weeks before those losses. Were you on a winning streak? Had you made exceptional gains? Were you feeling particularly confident about your trading ability? Document the specific trigger pattern for your overconfidence. Most traders have consistent triggers. Knowing yours allows you to implement safeguards when those triggers appear. Step 2. Create your success awareness protocol. Write a protocol that you must complete after any significant success. 3 wins in a row, a single large win, or a week up more than X%. Your protocol should include questions that force you to assess whether overconfidence is developing. Make this protocol mandatory, not optional. Success is when you're most vulnerable to overconfidence, so success is exactly when you need formal assessment processes. Step 3. Lock your position sizing. Implement hard technical limits on your position sizing. Use platform settings, separate trading accounts with limited capital, or trading software with risk controls. Make it technically impossible to violate your position sizing rules regardless of how confident you feel. Remove the ability to increase size impulsively. Protect yourself from your future overconfident self. Step 4. Implement pre-trade uncertainty reminders. Create a statement acknowledging uncertainty that you must read or say before every trade. Make it prominent, make it unavoidable. This statement should explicitly remind you that you don't know what will happen on this specific trade. This interrupts the overconfidence narrative before it takes control of your trading psychology. Step 5. Build winning streak management. Create a rule that either reduces position size or requires trading breaks after winning streaks. This feels counterintuitive, but if your data shows that your worst trading comes after winning periods, you need systematic protection during those periods. Don't try to push your advantage when winning. Protect your gains by maintaining your normal process. Step 6. Shift to process-based success definition. Stop measuring your trading success by short-term profits. Start measuring success by process execution quality. When success is defined by what you control, behavior, rather than what you don't control, outcomes, overconfidence has no foundation to develop on.
The fundamental truth about confidence in trading. Here's what Yale ultimately learned. The goal in trading psychology isn't to eliminate confidence. Confidence is necessary. You need to believe in your strategy and your ability to execute it. The goal is to calibrate your confidence appropriately. Confidence should be directed toward what you actually control: your decision-making process, your risk management, your discipline, your ability to execute your strategy consistently over time. Confidence should never extend to believing you know what the market will do next, that you can predict specific outcomes, that you're operating at some elevated level where normal rules don't apply to you. The most successful traders maintain what psychologists call humble confidence. They're confident in their process while remaining humble about their inability to control outcomes. They know their strategy has edge over time while accepting that any individual trade is fundamentally uncertain. This type of confidence is stable. It doesn't inflate into overconfidence after wins because it was never based on the illusion of controlling outcomes. It doesn't collapse into self-doubt after losses because it recognizes that losses are a normal part of executing a probabilistic edge. Your overconfidence isn't a character flaw. It's a natural human response to success that happens to be catastrophic in trading. You can't eliminate the tendency toward overconfidence, but you can build systems that recognize it early and prevent it from destroying your discipline. Success in trading will always feel good. Let it feel good, but don't let good feelings convince you that you've transcended the fundamental uncertainty of markets. Build systems that keep you grounded when success tempts you toward overconfidence. Your best trading doesn't come from feeling invincible. It comes from executing your process consistently while remaining humble about your limitations. That's not glamorous, but it's what actually works.